Good morning, everyone, and thank you for taking the time to join us for our 2023 interim results presentation. I'll let you read this slide to explain the basis of reporting in today's presentation. Reference is made to statutory results, which reflects both continuing and discontinued operations, as reported in our interim report for the 6 months ended 30th June 2023. This slide shows the running order for today. I'll comment on our performance and strategic priorities before Rachel covers off the financial results. And then I'll come back to talk about the outlook at the end before we take questions. When we presented the group's 2022 results at the end of March, I commented on the inflationary pressures that were mounting for households and businesses. Inflation has been more persistent than expected, and the Monetary Policy Committee has continued to take action, with the latest rate rise last week taking bank base rate to 5.25% for the first time in 15 years. We're therefore operating in a higher interest rate environment than we'd expected or planned for. The market now expects rates to be nearing their peak, although clearly households and businesses are yet to feel the full impact of those rate rises already made. As a result, we've continued to take a prudent approach to assessing customer affordability and remain focused on supporting our customers. We remain confident that the group's track record and resilience will continue to stand us in good stead. You will recall that we defined our new vision, purpose, at our first Capital Markets Day almost 2 years ago. Our purpose, to help more consumers and businesses fulfill their ambitions, has guided us in supporting our customers and business partners during these challenging times. We also articulated that the many opportunities that the group had to grow and add scale in our specialist lending businesses. Our growth has been executed effectively for 2.5 years now, and in that time, our lending balances have grown by 45%. That's just under £1 billion of net new lending growth. We are well positioned to continue growing profitably. We've refocused the group and are benefiting from established positions in our markets. Despite the volatility of recent times, we've been flexible in adapting to market conditions, and we see further opportunities grow strongly in what are large addressable markets. As we explained in March, all of our deposit funding is from retail customers. 96% of those balances are now fully covered by the Financial Services Compensation Scheme. We've continued to grow our deposits at record levels to support our lending ambitions. We have a strong capital base that provides capacity for significant further lending growth. We issued £90 million of fixed-rate callable subordinated notes, which qualify as Tier 2 in February. We are well positioned to deliver an attractive return on capital as we continue to execute our growth strategy, scale the business in line with our medium-term target. Building on the momentum of the last 2 years, we have laid the foundations for a strong full year. Some key performance metrics for the first half are shown on the slide. Lending balances of £3.2 billion were up by 14.8% in the last 12 months and up 8.2% since the end of 2022. Deposits from customers of £2.6 billion were up 15.6% in the last 12 months and up 5.3% since the end of 2022. In the first 6 months, we raised and retained over £1 billion of deposits from customers. Our net interest margin reduced to 5.4% from 5.7% at the same point last year. We view this as the low point, and net interest margin will increase again as the yield curve flattens. We had expected to see a reduction in the period as a proportion of lower risk prime lending grew in our consumer businesses and due to the natural time lag in passing through rate increases to those businesses. Rachel will comment further on operating income growth and margin shortly. On a statutory basis, our cost-income ratio of 56.9% was relatively flat compared to the first half of last year. Rachel will show a more detailed slide explaining the underlying improvement in our cost-income ratio, excluding non-recurring costs. On the back of strong lending growth and cost management initiatives, our profit before tax pre-impairments of £39.3 million was 14.6% higher than for the first half of 2022. The board has approved an interim dividend of 16 pence per share, in line with last year's interim dividend payment. Having delivered significant lending growth since the start of 2021, demonstrating our ability to capture the opportunities in each of our businesses, I am confident that we will deliver a significant increase in profitability in the second half of the year. In this next phase of executing our strategy, we need to be optimizing for growth and be even more focused on what our strategic priorities are. Further growth of the lending portfolios in these segments with the associated income increase, coupled with the continued simplification and streamlining of the group's operating model, will further improve our cost efficiency. We've defined 3 strategic priorities for the group: to simplify, enhance customer experience, and leverage networks. Our technology capability is a key enabler for us and will continue to strengthen our technology platform. By doing so, we remain well positioned to deliver market share gains and grow in our specialist lending segments and ultimately deliver on our return on equity target. We made significant progress against these 3 strategic priorities in the first half. We've completed the simplification of our business portfolio and we're on track to close the operations of DMS fully. We've taken further action to digitalise and automate processes and have reduced the number of documents and letters we print and post to customers. And we've also renegotiated a number of contracts with suppliers and business partners. We've reduced our property footprint further. Having already exited buildings in Rotherham and Cardiff in the second half of last year, in April we closed one of our buildings in Solihull, consolidating into the other building, which has become our new head office. Our head office building has been refurbished to support hybrid and collaborative working, and the further structural changes we made in the first half of the year to simplify our operating model. We've continued to focus on opportunities for cost removal and avoidance and are on track to deliver £4 million of annualised savings by the end of the year. In customer experience, we've continued to evolve and improve the self-service options available to customers, and our customer service is increasingly digital. Over 75% of our retail finance customers are registered for our online account management service, reducing the need for them to call us. Our open banking payment option continues to be well received by customers, with a growing number electing to make push payments to us by digital banking, rather than having to take the time to provide us with their payment card details. We're now operating all collections activity and vehicle finance on a single modern platform, removing complexity within the business. The platform has improved workflow management and automation. Recognising that customers were reluctant to lock their savings away for longer periods as interest rates in the market were rising, we extended our savings product range in the period to provide customers with a broader range of shorter duration fixed term accounts. We also introduced the confirmation of payee service so that customers can confirm that the name of the person they are looking to send money to matches the name on the bank account they are transferring money to, reducing failed payments and manual processes. We have a track record of achieving high levels of customer satisfaction. Our vehicle finance and retail finance teams were both recognised by FIFO and awarded their Platinum Trusted Service Award, and our savings team received FIFO's Trusted Service Award. And in commercial finance, the team was recognised as the Asset-Based Lender of the Year at the Real Deals Private Equity Awards. And leveraging networks, the group is built on the importance of strong relationships with business partners. We work with retailers, car dealers, brokers, private equity groups, accountants, and professional advisory firms. We help our partners satisfy the finance needs of their customers and clients, and we continue to strengthen our distribution network in each of our consumer finance businesses in the period. We launched the pilot of our mobile digital buy now pay later proposition AppToPay with a small number of existing retailers in Q2, delivering a solution that required no additional IT development by our retail partners. In vehicle finance, stock funding, we're now working with a broader range of auction houses and dealers, and we're increasingly seeing the level of repeat business grow in each of real estate finance and commercial finance. We'll continue to leverage our partner relationships and networks to originate new business, to expand our product offerings, and to take market share. Technology is a key enabler in delivering our growth efficiently. We've invested in our technology platform in recent years and will continue to do so. A number of enhancements are noted on the slide. This has allowed us to simplify the group and deliver better customer service by increasing digitalisation, replacing legacy platforms, and launching new products. We are able to integrate easily into our partners' sales, platforms and processes, allowing us to provide automated credit decisions and digital credit agreements. And this is one of the key reasons for our market share gain in retail finance. Our platform is scalable and has supported growth in our loan book of 45% and a deposit book of 33% in the last 2.5 years, and we have significant capacity to support our future growth ambitions. Let me just turn to the performance of each business unit. Some key data points are on the slide, and more information is in the appendix to the presentation. 3 of our businesses grew lending strongly in the period. Retail Finance's lending balances grew by 12% and Vehicle Finance's by 18%. As a result, Retail Finance's market share grew to 12.9% and Vehicle Finance's to 1.3%. Real Estate Finance's balances grew by 10% and the loan to value on the portfolio now is at 56%. Commercial Finance's lending balances dropped as we took a cautious approach to onboarding new clients in a challenging environment. There was an increase in the cost of risk in Commercial Finance due to us recognising a loss on a long-running problem loan case. As you know, the team has a fantastic record in managing the portfolio exposures. Including this loss on that one case in the first half, the cost of risk since launching the business in 2013 is 0.6%. Commercial Finance's net revenue margin and income grew strongly in the period as the lending portfolio is variable rate priced and linked to the bank base rate. Overall, the group delivered against our strategic priorities. We've continued to expand our distribution networks, grow new lending and total lending balances, and increase market share in our consumer businesses. The group made good progress in the first half of the year, and we've again seen the benefit of having a diversified yet focused specialist lending portfolio. With that, let me now hand over to Rachel to take you through the financial outcomes in more detail.
Thanks, David, and morning, everyone. I will start with a brief overview of the income statement on slide 12. As you've heard from David, our growth plan continues to be executed effectively, and we delivered a 10% increase in operating income in comparison to the prior year. With the backdrop of high and sustained inflation and the growth in their lending balances, operating costs increased by 9.7% on the same period last year. However, there was a number of non-recurring items included in that headline number, and I will provide some further detail on this later in the presentation. Our strategy of adding scale to our specialist lending businesses, alongside simplifying the group and driving operational efficiency, has delivered a significant increase in profit before tax pre-impairment, a 14.6% increase over the prior year and 39.3% since half 1 2021. Continuing profit before tax of 16.5 million was down 3.5% on the same period last year, but was impacted by a loss of 7.2 million in Commercial Finance. Without this loss, continuing profit before tax would have been 23.7 million, a 38.6% increase on the same period last year. Net interest income in the first half at 81 million is a 10.8% increase on the prior year, with a 16.3% increase in average lending being the key driver of this performance. The raising of new Tier 2 debt earlier in the year has impacted net interest income with an increased cost of £3 million. However, this additional cost is outweighed by the increased capital it provides to support our growth and suite of medium-term targets. As David has already mentioned, we are operating in a higher interest rate environment than we had expected and planned for. And as previously indicated, while the base rate continues to rise, we suffer from a lag in passing through these rate increases, in retail finance in particular. We have been proactive in managing the pass-through of rate increases to both lending and deposit customers and have achieved a relatively neutral position in relation to NIM, with a 10 basis point contraction. As I just mentioned, the increased Tier 2 in both coupon cost and quantum has reduced net interest income, and the impact on NIM is 20 basis points when comparing to last year. Overall, our NIM has contracted by 30 basis points to 5.4%. However, we expect this to be the low point for the year, and NIM has already moved up to 5.5% on a July year-to-date basis. Furthermore, with the yield curve predicted to flatten by the end of the year, we should see margin expansion into 2024. On a statutory basis, operating costs were up 4.5 million and the cost-income ratio was largely flat on the same period last year. However, as we have reported in previous periods, there are a number of non-recurring costs which distort the underlying performance in relation to operating costs. Excluding these non-recurring costs, the cost-income ratio reduced by 1.7% to 54.8% period on period. One of the key drivers of meeting our medium-term target of a return on average equity in the mid-teens is by delivering growth in income whilst keeping cost growth lower, i.e. widening the jaws. As you can see from the waterfall on slide 14, the impact of this widening of the jaws delivered a reduction in the cost-income ratio of 5.1% from income growth, less the volume-related cost increase of 1.7%, a net reduction in cost-income ratio of 3.4%. We are living in a high and persistent inflationary environment, which manifests in pressure on salaries and other costs. The impact of this is an increase in the cost-income ratio of 2.6%. We continue to find opportunities for cost optimization through our Fusion project, and we delivered an additional 0.8 million of savings in the first half, and are on track, as David said, for the 4 million of annualised savings by the year end from this programme. Asset quality continues to be resilient within our consumer finance businesses. Retail finance has delivered sustained low levels of arrears as a result of the strategy to focus on higher quality prime interest-free customers. Vehicle finance near prime arrears have reduced to levels similar to pre-pandemic, and combined with the new prime segment, arrears levels have significantly reduced in the half. As the proportion of prime grows, this trend will continue. Cost of risk for the first half of 2023 at 1.5% was slightly elevated as a result of a 7.2 million loss on a long-running problem debt case in commercial finance. The circumstances around this particular case were unique, with a lessons learned exercise confirming no similar concerns across that portfolio. As David mentioned earlier, the track record of commercial finance since its inception, including this loss, is only 60 basis points. On a more positive note, as indicated at the 2022 year-end presentation, vehicle finance cost of risk reduced significantly to 2.4% from a high of 8% in the first half of 2022. This is a result of the credit tightening actions taken throughout 2022, now being reflected in the IFRS 9 modelled output. We expect the cost of risk to settle into a range of 3 to 4% in the next few years, but it is dependent on the mix of prime and near prime lending. Impairment provisions increased by 1.5 million in the first half. If I can point you to the waterfall on slide 16 for some further detail. The impact of growth in net lending increased provisions by 11.6 million. This was offset by a release of 3.2 million from improving macroeconomic assumptions and other movements of 6.9 million. We do continue to retain a management overlay of 2.8 million for affordability due to the current economic climate. Coverage ratios decreased marginally to 2.5% and still remain prudent. At a summary level, the balance sheet grew with total assets increasing by 5.1%, driven by an increase in loans and advances to customers of 8.2%. Loan to deposit ratio increased by 3.1% as we funded loan growth from surplus liquidity held at December 22 for the business finance pipeline. Tangible book value per share increased by 2% to £17.46. We continue to deliver strong momentum in customer lending in the first half from established positions in our specialist lending market. Net loans and advances increased by 8.2% in the first 6 months of the year, with strong growth being delivered in both our consumer divisions and real estate finance, as a result of leveraging current and new distribution channels and products. Retail finance grew 11.9%, vehicle finance by 18%, and real estate finance by 9.5%. Commercial finance did see a contraction in lending balances of £60 million, reflecting seasonality and a cautious approach to new clients in a challenging economic environment. We are a diversified business and have proven our ability to be flexible in adapting to volatile market conditions, and we see further opportunities to grow strongly in our specialist lending markets. Aligned with our growth strategy, we have consumed capital in the first half to fund this growth. CET1 ratio reduced by 1% to 13% through a combination of capital generation from profits, net of dividend, the unwinding of IFRS 9 transitional reliefs, and growth in lending and associated RWAs. We issued 90 million of new Tier 2 to support growth and efficiency in the capital stack in the period, and we redeemed the existing 50 million Tier 2 with a 2023 call date. This additional Tier 2 provides us with sufficient capital for our planned growth, and we will have no requirement to go back to the market to raise any further until the call dates in 2028. Our capital ratios remain significantly above the regulatory minimums. Total funding increased by 6.2% in the half to support growth in lending. Retail deposits grew by 5.3% in the period, mainly through growth in Access and ISA products. And to remind you, around 96% of these are fully protected by the FSCS. Our full range of products enabled us to actively manage shifts in customer behaviour away from shorter dated and cheaper noted accounts to longer dated and more expensive fixed term accounts by us increasing our levels in Access accounts. Cost of funds is of course impacted by the increases in base rate, and we continue to actively manage the pass-through of these increases to both deposit and lending customers. Lastly, all regulatory metrics remain strong and significantly in excess of regulatory minimums. Let me now hand back to David to take you through the strategy and outlook slide.
Okay, thank you, Rachel. Let me just make a few comments on the outlook for the group and our core areas of focus as a team. Our vision, purpose and strategy is well understood and embedded across the group, with clear opportunities to help more consumers and businesses fulfil their ambitions and grow our lending further. We have built a track record of capturing those growth opportunities in each of our specialist lending markets. We need to continue doing the same in a prudent manner as we move forward and scale the group further. We've defined our optimising for growth strategic priorities so that we maintain focus on simplifying the group, enhancing customer experiences and leveraging our networks. Under Simplify, we'll continue to take action this year to streamline our activities and are progressing additional work streams to deliver the £4 million of annualised savings by the end of the year from our cost optimisation programme. We'll further enhance the experience of our savings customers with the launch of our new digital savings app, allowing customers to manage their account on the device of their choice when it suits them. And that will reduce the need for many customers to call us for account and balance information. On leveraging networks, we'll continue to work proactively with existing business partners to reach our end customers and also to grow our distribution network further. And we will continue to make enhancements to our technology platform as we expand the business and drive further cost efficiencies. We've laid the foundations for delivering a strong performance for the full year. We're a focused specialist lending business and a diversified and resilient model remains a key strength. We have proven ourselves to be flexible and disciplined when helping customers and managing our loan portfolios. We're a growth business with further opportunities ahead of us, and we have strong capital and liquidity positions to help us to continue to capture those opportunities. Having defined our optimising for growth strategic priorities, we will remain laser focused on driving continuous improvement and leveraging technology to achieve our growth ambitions. And with a growing balance sheet, we expect a significant increase in profitability in the second half of the year. We'll be holding a capital markets event on Wednesday, 8th November. The event will have two objectives. Firstly, to set out clearly the path for delivery of the medium-term targets, and secondly, to allow the V12 Retail Finance team to outline the strengths, capabilities and further opportunities for that business. We will, of course, send out invitations well ahead of time. We've made significant strategic progress and demonstrated our ability to execute our strategy and grow. We are benefiting from the actions we've taken to simplify the group over the last 2 years and from the technology investments we have made that allow us to deliver enhanced customer experiences a broader range of products and to drive further efficiencies. As we continue to expand and leverage our distribution networks, we are confident in delivering sustained growth in our chosen markets. Continuing to capture growth is key. Since the start of 2021, the team has grown lending balances by 45% and deposit balances by 33%. As a result, we are on track to deliver all our medium-term targets. We look forward to sharing more insights on the delivery of those targets at the Capital Markets event on the 8th of November. That brings the presentation to a close, and we'd be happy to take any questions you may have. Thank you.
Ladies and gentlemen, if you wish to ask a question over the phone, please signal by pressing *1 on your telephone keypad. And please make sure the mute function on your phone is switched off to allow your signal to reach our equipment. You may also submit your questions on the web platform. Again, please press *1 to ask a question. We will take our first question from Robert Sage from Peel Hunt. Please go ahead.
Yes, good morning. Thank you very much for the presentation. I've got a couple of questions. The first one, looking at the 7.2 million one-off charge in commercial finance, I was wondering whether you could comment more widely about the lumpiness of your exposures within this particular portfolio, what perhaps the average balance size might be, whether or not there could be many other exposures of the same sort of materiality as the one that you provided against today. The second question, and I apologise if this is slightly remedial in nature, is that there is about 15.4 million of revenue showing in the other division, and maybe I've missed it, but I'd be very grateful if you could just sort of talk around what that is and how that number might trend in future periods.
Okay, thank you for the questions, Robert. Morning. On the first point, the commercial finance, that level of balance is not actually untypical. So I think we've indicated for a period of time that balances were in the high single-digit millions. So I don't see it as being out of line with the sort of average exposure. And your second question actually broke up slightly for me, but I'm not sure if Rachel caught that.
So you're asking about the 15.4 million in other. So that's a combination of two things. That would be excess income coming from our internal FTP process, plus also Bank of England interest. And the reason why it would be significantly higher would be just the rate environment that we're in.
Okay, so if the rates stay up here, we would imagine that might simply recur at around the current level?
Yes, but you're picking that up from the segmental analysis, but obviously we report that at group level as a total number.
Thank you.
Thanks, Robert.
Thanks.
And our next question comes from Perlie Mong from KBW. Please go ahead.
Hello, thank you for the presentation. Just two questions. One is around stage 3 balances. If I look at your business finance stage 3 balances, that seems to have gone up quite a lot in the half, especially, I guess real estate finance is a little bit lumpy. I think it went from 30 million to 17 and then back up to 40, but commercial seems to be quite a bit higher. So just wondering what is driving that stage 3 balance, because it doesn't sound to me that you're seeing a material credit deterioration in your portfolio, generally speaking. So that's the first question. And second question is on cost. So I think in your presentation, you talked about Project Fusion delivering 0.8 million of cost savings in half one, but you would expect a 4 million annualized by year end. So just wondering, so it sounds like there's a sort of step up in cost savings in half two. So if you could just give us a bit of colour on where that might come from in terms of what's driving that say 3 million of cost savings, that would be really helpful. Thank you.
Thanks, Bernie. I'll probably pick up both of those. So the stage 3 balances in commercial finance and REF. I mean, as you say, REF is a bit lumpy, and there is one case in there that has moved into stage 3 from the period before December 22. But on commercial finance, again, there is stress in commercial finance in terms of the clients that we're dealing with, and we do get companies going into administration. So there are 2 new companies that went into administration in the first half. One of those is already collected out in July, and the other one is practically collected out in July with no issues on full collection of those debts. So it's just ultimately what's happening with the market, that we are seeing companies that we're providing funding to going into administration, and therefore we're having to collect out on them. So hopefully that answers that question. The second one on costs. So when we talk about the 4 million annualised rate, that's from the point of the 1st of January 2021 when we started the programme. So if you recall, at the end of last year, we had 2 million annualised, and we're confident of getting to the 4 million by the end of the year. And it's still on the same things that we've discussed before, which is operating model changes, property. Obviously, we've moved into York House, which is one of our buildings in the Solihull, and just supplier contract work that we're doing. So when we're talking about the annualised, it from when the programme started at the beginning of 2021.
Okay, sorry, my mistake then. So presumably cost savings half one, half two would be sort of similar level of magnitude, maybe a little bit higher in half two. Would that be fair?
Higher. Yeah, that's fair.
Okay, thank you.
Thanks, Ben.
Thank you. And as a reminder, to ask a question over the phone, please signal by pressing *1, and you may also submit your question over the web platform. Now, our next question comes from Alexander Bowers from Berenberg. Please go ahead.
Morning. 3 questions for me. First one, just you grew market share in both retail finance and vehicle finance in the period. What sort of market share do you believe is achievable in each of these segments, sort of the medium to long term? Secondly, on App to Pay on the pilot, do you have any initial or early customer feedback or views on the level of demand from App to Pay from the launch? And lastly, you mentioned sort of a cautious approach to new clients in commercial finance. Are there any types of business or particular industries you're looking to reduce exposure to? Thanks.
Okay, thanks, Alex. On the first question on market share within the consumer finance businesses, so that 12.9 in retail finance at the end of the period is still when we have one of the second largest competitor in the market, but they are gradually coming out of the market. So our expectation is in the sort of medium term, you would be getting into mid to high teen% in retail finance. On vehicle finance, second-hand finance at the point of sale, clearly it's a much broader market now that we've expanded into the prime segments. So against that 1.3 level, you would be not far off doubling in the medium term. And that's consistent with what we've said about having done the product expansion, continuing to extend our distribution. We will start to see continued market share growth. So you're probably in the 2.5% range in the medium term there. So both still have good opportunities to grow. On App to Pay, listen, what we've done is a pilot. It's with 27 existing retailers across different market segments and sectors. Our key focus at this stage is just making sure technology works, process works for our business partners as well as our end client. Too early at this stage to say at what point would you be comfortable or have enough learnings to either continue rolling out the proposition as is, or whether you may need to make any adaptations. The one thing I think probably worth highlighting is we took a little bit longer to launch the pilot than we'd expected, but that's because our in-house IT development team found a solution that required a bit more development work on our side, which removes the need for any technology development work with the 27 partners. So that means that once we are comfortable and we want to extend distribution, we can do that very easily, but just adding it as a drop-down list option into the tool system of our partners. So very early stages, low pilot, just until we learn, make sure we are very comfortable before making a decision on further rollout. And in commercial finance, there are no specific sectors actually that we have made any decision over the last 6 months to step away from. As Rachel says, there is clearly a very volatile market. It's also a very competitive market. This business does well almost, when there's actually restructurings taking place or acquisitions taking place, and we can support and provide working capital. So it's probably more the fundamentals of the businesses that we're supporting, what their growth trajectory and profitability and returns trajectory is, that drives our decisions rather than any specific decision we have taken about market segments.
Thank you.
Thanks, Alex.
And our next question comes from Rob Murphy from Edison. Please go ahead.
Hi guys, can you hear me?
Yeah.
Yes, hi Rob.
Great, thanks. Just coming back to the costs again, and the operating leverage. So it looks like the underlying cost growth is about 6.5%. And I just, obviously that's including the benefit, that's before the fusion benefit. And so I'm just going, is that a sort of a, is there any reason to expect any kind of different trend into the second half? And secondly, on the one-off costs that you had, what were those, and is there anything also likely in the second half on those? That's the first question. I've got a follow-up on something else.
Yeah, so in terms of first half versus second half underlying cost, I wouldn't expect it to be materially different. Hopefully we will be exiting such a high inflationary environment, then we should be seeing a better run rate into 2024. In relation to the one-off costs, I think most people are aware that we continue to look at different opportunities, and they come with associated costs. We can't probably go into too much more detail on that. We're probably not expecting similar costs into the second half, but there may be some. Okay, great, thanks. Then just going on to slide 16 on the IFRS 9 provision, the 5.5 other release there. Could you maybe give a bit more colour about what's driving that? And I also note is that linked to the vehicle finance, where you're seeing this sort of transition to the prime, or is there something else happening there? Thanks. Yeah, it really is lots of different things. I think there's a footnote on the slide. I mean, this is stage movements, which would have had an impact in relation to vehicle finance, because obviously the models themselves would have been pushing too much into stage 2. So we would have seen things come back out of stage 2 into stage 1. But there are just the normal maturities, curing that goes on within the IFRS 9 models. So there's nothing hidden in there. That it is probably lower than we would, or more of a benefit than we would expect, because of the stage transformation between stage 2 and stage 1 in vehicle finance. Great. And I just had one final thing. I don't know if it's on your economic scenarios. I think you have a chart. It says HPI % for the house. Is that right? That scale, or is it the absolute house prices? Is there something that doesn't look quite right there? That was all I just wanted to point out. I think you've got positive house price growth, which doesn't feel like what you've actually assuming.
No, and so on slide 32, Rob.
Yeah, it's at the end on there.
No, so the HPI is for the third and sixth columns, which are negative.
Okay, maybe I've got something wrong. Okay, that's fine. Yeah. All right. Thanks very much.
Thanks, Rob.
Thanks, Rob.
Thank you. We'll now take our next question from Gary Greenwood from Shore Capital. Please go ahead.
Oh, hi. Thanks for taking my questions. I've got two, please. First one was on vehicle finance. I noted one of your peers recently stated they'd seen an increase in frivolous claims, which had cost them a little bit of money. I was wondering if you'd seen anything similar within your vehicle finance business. And then the second question was just on dividend policy. Obviously, you held the dividend in the first half of the year. I think you said you're still looking at the 25% payout. I was just wondering if you'd consider reviewing that dividend policy, either to put a progressive overlay in place, or alternatively cut the dividend altogether and buy back stock, given where the rating is. Thanks.
Yeah, thanks, Gary. On the first question on vehicle finance claims, so listen, we've seen an uptick, but from a very low level. So actually, it's relatively immaterial, the cost of handling those claims. So nothing to call out specifically, and it's nothing that would lead us to have to call it out as a significant item. So it's already all in our operating cost line. On the dividend policy, yes, you're right. It's been held at the 16p, broadly the 25%, in line with the policy. Listen, I think despite the fact that the statutory profit has reduced slightly, I think you can take it as a sign of our confidence in the full year. We have not at this stage made any decision clearly to change the dividend policy, but we have certainly heard and fed back and discussed with our board that some holders would have an expectation of some type of overlay or some progressive nature being built into the policy the next time it's reviewed. So nothing to say or no decision made at this stage, Gary, but certainly we've been listening to the feedback we've had.
That's great. Thank you very much.
Thank you.
Thanks.
Thank you. Is there no further questions in the phone queue? I will hand it over to Scott for any eventual web questions. Over to you, Scott.
Thanks very much for that. We've currently got no questions from the webcast today. So David, hand back to you for closing remarks.
Okay, thank you, Scott. Well, listen, thanks everyone again for joining. Listen, I think we've demonstrated again the ability of the teams to capture the growth. We still have relatively low market shares, probably bar retail finance at 12.9% in very large niche markets. So we remain very confident, looking very much forward to the second half of the year, seeing a step up in the level of profitability that we're delivering. And we're looking forward to being able to describe and talk you through on the 8th of November at the Capital Markets Day, the trajectory and the path and what needs to happen for us to consistently deliver the medium-term targets and deliver the mid-teens returns that we've indicated within those. And it will also be an opportunity for the broader retail finance management team to get visibility and for you to hear more about the strengths, capabilities and further opportunities to gain market share in that business. So, thank you. I know we'll be meeting some of you over the course of the next few days and look forward to talking then. And thanks for joining this morning.
Thank you.